We'll talk about those Fed minutes and the markets and everything else. Thomas Hayes, founder and managing member of Great Hill Capital, a long-short equity manager based in one of my favorite cities, NYC. So last time we checked in with you, Thomas, you still had the bull in you. It's now a couple percentage point down, and we've got the inflation thing not figured out. There's some questions there, and we haven't solved Europe. Do you still feel the same way?
Well, I still have the exact same sentiment, Phil. Thanks for having me. And it was bullish, but we also did say we expect during the period of seasonal weakness, August, September, 3 to 5% pullbacks, which will be bought. So here we are 2 weeks later, we're down 10 out of the last 12 days. And we've got 3 to 5% pullback, 4.3% right now. During this seasonally weak period. But the part of the thesis, if you recall, was that dips will be bought because most managers missed the first half rally when the S&P was up 17% plus. And these 3 to 5% dips are going to have to be bought. So we're going to find out in coming weeks, do they show up to the party? What we saw in the Bank of America survey yesterday among institutional managers is that while the cash levels are slowly coming down, they're still dramatically overweight T-bills and underweight equities relative to their past 20-year history. So they are still going to have to play catch up, and we do think that there's opportunity to buy these dips of 3 to 5%. And we also think that those people waiting for a 10 to 12% correction will be waiting for a long time.
But couldn't the opposite be true? I mean, hedge fund managers like yourself get paid as a percentage of profits. So let's just say you make $100 million. $20 million is basically the profit that gets paid to yourself or your own hedge fund. In other words, you're doing so well this year. At some point, wouldn't these successful hedge fund managers want to lock in their gains, which essentially means locking in their bonuses for the rest of the year?
Yeah, well, many of the managers have underperformed because they were very bearish and they were very much in cash, and now they have to chase. And what we're finding, what we saw in earnings season here, with everyone coming in pessimistic, expecting negative 7.3% earnings, is if you back out energy, earnings in aggregate were up 3% year on year. GDP now was printed. The Atlanta Fed GDP is expecting 5.8% GDP for Q3. So this economy is firing, but you do have to find selective opportunities, and there are tremendous opportunities moving forward.
So the word is stronger for longer, and I'm referring to rates, and you can see that in what the 10-year is showing, because we haven't seen 4.25%, at least in recent memory. I've heard numbers from 4.5% to 4.75% to maybe even 5% on the 10-year. Explain to our viewers why that matters, because people often ask me, and I give my answer, but I think you could probably do a better job. Why does it matter that the 10-year keeps moving higher, and why is that perhaps a negative for stocks?
Well, we're knocking on the door to the high yields from last fall. Generally, the higher rates go, the lower the present value of the future cash flows for stocks. I will say that from 95 to 99, we had a Fed funds rate of 6%, and we had one of the biggest rallies in history. So you have to take that with a grain of salt. But what we do find this time around is when that 10-year gets over 4%, things start to break. We saw it last year with UK. We've seen it a couple of times. So I think at this level, we're probably getting toward the top end of yields, and we will see these start to roll over. Keep in mind, we're putting $1 trillion of supply on the market in a very short period of time. So this may be an aberration in terms of the yield blowout in the short term and little short-term fear. But I would bet as we move towards the end of the year, as the market starts to discount cuts in mid to late 2024, you're going to see a compression in yields. You're going to see a bid in the 10-year. And I would not be surprised at all before the end of the year if the 10-year yield is 3.25 or less.
Am I, tomorrow or later this week, am I buying, selling, or doing nothing?
I think you're buying businesses with a durable moat that are dramatically on sale, and you're taking the long view. One of the ones that we like on this weakness is PayPal. PayPal is trading at 10.5 times forward earnings. They're going to grow earnings next year at 14%. Their 5-year growth rate is 17%. Their historic multiple is 35 times. Oh, and by the way, they just got a brand new CEO. This is the guy who ran half of Intuit, which has been a 25 bagger over the last 13 years, and he's going to bring his growth story to PayPal, and I think we're going to see very positive things moving forward. So you just have to be selective. You know, it's perfectly possible that the market could go sideways, grind sideways. We're certainly not going to get in the back half what we got in the front half. We're not going to get plus 17%. I think we're going to get plus mid-single digits, and the opportunity to make money is going to be under the surface with discrete businesses that are on sale but growing. This business has compounded capital in mid-teens for over a decade. They're going to continue to do so and maybe even accelerate with the new CEO, Alex Chris.
Real quick, I know you follow banks. I know you follow the real estate market, of course, and you're long short.
Yeah.
What are we shorting?
We're shorting pessimism right here. I think there are too many businesses that have come down materially because of COVID, because of the COVID aftermath, that have created once-in-a-generation opportunities. And when you look at the PayPals of the world, et cetera, what I would be shorting, I would be shorting the counter-trend rally of the U.S. dollar. I think as we move into year-end, the dollar is going to resume its downtrend that it started in October, and that's going to fuel flows back into emerging markets. We've had the short-term counter-trend move. But that's going to reverse and normalize, and we're going to see good things in emerging markets in coming months.
All right, next time we're going to get to Asia and China. I could do this all day long. Thomas, we love having you. Thank you very much.
Thanks for having me, Phil.
Much more to come.